Is the stability of the cryptocurrency market a myth? This is Makuto, and today we're diving into a topic that might ruffle a few feathers. We've all heard the tales of overnight millionaires, of digital currencies that promise a financial revolution, but what if the foundation of this revolution is as shaky as a house of cards? What if the stability we perceive is just an illusion? Hold on to your hats, folks, because we're about to delve deep. What if we told you it's all a bubble waiting to burst? To understand this better, we need to dive into economics and understand the concept of a bubble. Now, when we speak of an economic bubble, we're not referring to those delightful spheres of soapy water that float around and then pop. No, this isn't about child's play. It's about a serious, often devastating phenomenon that occurs in our financial markets. Imagine you're at an auction. A rare piece of art is up for grabs. The bidding starts low, but as more and more people show interest, the price begins to skyrocket. Everyone wants a piece of the pie. They believe the value of this art piece will continue to rise, and so they're willing to pay more and more for it. This is how a bubble begins to form. But here's the catch. The actual value of the art piece hasn't changed. It's still the same piece of art. The inflated price is purely a result of people's expectations. This is the bubble. A situation where the price of an asset detaches from its underlying real value. As time goes on, the price continues to rise, fueled by speculation and exuberance. More and more people jump in, hoping to make a quick buck. The bubble grows larger and larger, but eventually, something has to give. The bubble becomes unsustainable. People begin to realize that the price of the asset is way too high, and it doesn't match its real value. They start selling off, and the price begins to plummet. Panic sets in, and a sell-off frenzy ensues. The bubble bursts, leading to a rapid drop in prices and often an economic downturn. This cycle of boom and bust, of euphoria and despair, is unfortunately all too common in our financial markets. It's happened before with tulips in the 17th century, with the dot-com companies in the late 90s, and with the housing market in the mid-2000s. So, how does this apply to cryptocurrencies? Let's delve deeper. Cryptocurrencies, a digital gold rush, but is it just a bubble ready to pop? Welcome back to our journey, folks. Now we dive into the heart of the matter, the cryptocurrency bubble. As we've learned in the previous scene, economic bubbles aren't a new phenomenon, but the world of virtual currencies, with its dizzying highs and terrifying lows, seems to be in a league of its own. The rise of cryptocurrencies has been nothing short of meteoric. From being a niche concept known only to tech enthusiasts, cryptocurrencies like Bitcoin, Ethereum, and countless others have now entered the mainstream consciousness. The allure of digital money, decentralized, anonymous, and seemingly limitless in potential, has led to a mad scramble. People are buying in droves, hoping to ride the wave to unimaginable riches. But is this sustainable? History has shown us that what goes up must come down, and the higher it goes, the harder the fall. This is the essence of a bubble. The value of cryptocurrencies has been driven up by speculation, by the belief that their value will continue to increase. But this belief is not grounded in any tangible asset or economic activity. It's based on the hope that someone else will pay more for it tomorrow than what you paid for it today. This is what economists call the greater fool theory. So what happens when the bubble bursts? When people realize that the value of their digital assets isn't backed by anything tangible, the result can be catastrophic. Prices plummet, investors lose their money, the market crashes. Remember the dot-com bubble of the late 90s, or the housing bubble that led to the global financial crisis in 2008? The consequences can be far-reaching and devastating. The signs are there, but the question remains, when will the cryptocurrency bubble burst? As we move forward, we'll explore what it might look like when it does and how it could impact the global economy. So stay tuned, because this journey is far from over. So when is this bubble going to burst? Well, that's the million-dollar question, isn't it? Or, with the way things are going, perhaps I should say the million Bitcoin question. The truth is, it's impossible to predict with pinpoint accuracy when the cryptocurrency bubble will burst. However, we can identify potential triggers that may cause this bubble to deflate. One possible trigger is regulatory intervention. As cryptocurrencies become more mainstream, it's likely that governments around the world will want to exert more control over them. This could take the form of tighter regulations or even outright bans, which could significantly impact the value of cryptocurrencies. Another potential trigger is a large-scale security breach. Cryptocurrencies rely heavily on technology, and as we all know, technology isn't infallible. A major hack or other security incident could cause a loss of confidence in cryptocurrencies, leading to a rapid sell-off. Now, let's talk about the fallout. If the cryptocurrency bubble bursts, the impact could be far-reaching. Not only would investors lose money, but it could also have serious implications for the global economy. The exact nature and scale of these implications are difficult to predict, but it's safe to say that the effects wouldn't be confined to the world of finance. In conclusion, the bursting of the cryptocurrency bubble is an inevitability. The bubble has to burst. It's not a question of if, but when. We've taken quite a journey today, haven't we? We dove deep into the intricacies of economic bubbles and how they manifest in our financial world. We explored the concept of the cryptocurrency bubble, a phenomenon that's been making waves in recent years. This bubble, like others, is characterized by rapid escalation of asset prices followed by a contraction. It's fueled by speculative trading and inflated expectations. And as we've discussed, it's destined to burst. The repercussions? They could be significant, impacting investors and the broader economy alike. But here's the key takeaway. Bubbles are not inherently bad, they're a part of the economic cycle, often signaling innovation and progress. The challenge lies in understanding these patterns, recognizing the signs, and navigating the financial landscape accordingly. Remember, bubbles are a part of economics. It's all about understanding and navigating through them. Don't forget to comment, like, and subscribe for more insights. This is Makuto, signing off.